Thanks,
Perfect.
Sean.
You got it. So welcome everybody to today's Monday morning mortgage update. It's going to be an action-packed week with it's jobs week. So that's going to be a big mover because we all know that that's one of the most important aspects of what the Feds are trying to do. They're trying to increase the unemployment numbers. So we're going to have a real close look at that this week. And I'm going to go ahead and share my screen and jump right in. So bear with me one moment as I do so. All right, everybody, let's get started. So, what happened in the mortgage industry this last week? So, I don't know if you guys remember, but last week I was really wanting to break free. Remember, I had um, those images on there with the chains breaking, like we needed to get out of this pattern. Well, the pattern was this downward trend that we had where literally for 3 weeks, the bond market was in a trajectory pretty low. And we tried to break out here and it went all the way down. We tried to hit here and went down. And then on Monday last week, we broke through this. And Tuesday, we tried to get above. So we're breaking up, breaking up, breaking up. And then we finally broke through to the other side here. And now we've got a trend line that started and we're just at the base of it right now. So we're in like a squeeze right here. So we've got a level of resistance right here on the 25-day moving average. We've got the Fibonacci below us, and we've got this trend line. So it's going to squeeze us in here, and hopefully we'll break through. What will help is weak numbers on the jobs report. So that's going to be really important to better rates as we go. So we're going to be floating into the jobs numbers. I'll go into that next as far as what's happening. But I want to show you this right here is only one of the mortgage coupons that's trading. But believe it or not, there's multiple mortgage coupons that have these ranges of trading every day. And here's what they look like. So we've got a 6% bond, we've got a 5.5% bond, a 6.5% bond, and that's uniform mortgage-backed securities. We've got a 10-year. We have Ginnie Mae, which is FHA and VA. They react differently than the markets. So sometimes we see VA get worse and conventional get better, or they're at the same time. Notice this coupon is down 28 basis points for the day. That's pretty bad. So lower rates, really low rates got more expensive to get today. So if you wanted to buy the rate down to 5.5, it's now more expensive. So this is kind of what I look like every day. I haven't really showed this before, but this shows the different coupons for different rates that are available. So just thought that'd be interesting to show. So where are we now with actual interest rates? Well, here's the generic. I like to say it's generic because this is Google's algorithm that puts together all of the rates through Fannie and Freddie and what the average is for the nation. Okay, so we can probably do better than this, but this is just what the average is for the nation. This way I don't have to go into APR and into points and all of that kind of stuff. But 30-year fixed, we're in the low sevens. And this is an average across the country with no points. 15-year, we're in the sixes. But look at VA and FHA. I found this is a little bit interesting how they're a little higher than a conventional 30-year fixed right now. That's because that mortgage coupon we talked about earlier right here is trading in worse levels than the conventional uniform mortgage-backed security. So interesting how that's a little higher currently, because usually that's a little lower on the VA and FHA than conventional. So I thought that was really, really interesting. So we have a crazy week this week, guys. We have a lot happening, and here's the calendar. Today, there's literally nothing happening. So thought that's interesting that there's nothing happening. We have manufacturing coming in tomorrow, factory orders. That kind of shows the direction of what the big companies are doing. Then we have ADP. We have the private payroll change. That's going to be really interesting to watch, really keeping an eye on that. And then we have the Fed chair speaking at, 8 a.m. So Mr. Powell, we'll see what he has to say. We had the job openings, the JOLTS report. That's going to be interesting as well to see kind of how many job openings there are countrywide. And then on Thursday, we're going to see the Challenger job cuts. Those companies that are announcing that they're going to have layoffs. We're going to see initial jobless claims, continuing jobless claims, some non-farm payroll activity. And then again, Mr. Powell speaking as well. And then we're going to go over consumer credit change, what's happening with consumer credits on Thursday as well. So lots happening there. All of this can really show us some cracks that are starting to show in the markets because of these higher rates. And then on Friday, the unemployment rate is going to be coming out. It's supposed to stay the same. If we get it peaking up a little higher, that would be a lot more beneficial for mortgage rates, but it's supposed to be the same. So that's not really good news for mortgage rates. I'm expecting it to be kind of the same status quo. We'll see what really happens. So this is what the feds are afraid of. This is in the gray, the inflation trajectory and the changes in inflation in the 1966 to 1983. We are on the almost exact path below that. This is 2013 to now. Notice a spike, then down, a spike, and then came back down, and then a big spike, and then a big comeback down. And notice this little bounce higher. So the feds do not want a repeat of what happened back here. They do not want that. That's their absolute worst case scenario. Egg on my face. I'm not a good Fed chair if this happens, type of a perception that he has on what's happening now versus what happened back in the 80s. We all know what happened in the 80s. It was just ugly. He does not want that to repeat. So what is going to happen? Well, higher for longer. I believe that the markets are all predicting the rates are going to come down pretty quickly. Remember where they all thought March, but then inflation got sticky. And this wage inflation, guys, it's the scary part, because wage inflation, there's no going back from that. Once you increase wages, there's no going back. The cost of goods can vary because of manufacturing costs, because of just overall demand, but it very rarely happens when the minimum wage actually goes down. It doesn't happen. So once we go high on that, it's going to stay hot, and that's what I'm really afraid of. So I believe the Feds are going to go higher for longer. We'll see when they actually end up lowering rates, but I honestly think we're going to be in a little bit of a higher range in rates for a little bit longer, maybe in through the summer. We're going to really see what happens with the economy. If these cracks in the economy start to get bigger, then he'll probably rethink what's happening with the Fed funds rate. We're not exactly the same as the markets back in the 70s and 80s. We are very different, but he does not want that to repeat. So his knee-jerk reaction is going to be, let's keep higher rates for a while so we can really control this inflation. Now, his inflation, he wants to get down to 2%, remember, and we're in the 3s right now. But if it spikes back up, it's going to be interesting. So we'll keep really a close eye on that. But this is the inflation on the wages is what I'm really afraid of, especially with California doing these $50 an hour proposals for minimum wage. $50 an hour for minimum wage, that's going to be strange. That would really hurt inflation. So keep an eye on that. So the question is, what is the buyer looking through what's happening? What is the buyer thinking right now? Like, what are they thinking? What is the perception of the buyer? And that's what I'm going to talk about right now. What is the perception of this market to a home buyer? If we sit in the home buyer's shoes, what are they seeing? What are their fears? And how can we help them make sense of all of this? Because this is what they're seeing. Perception versus reality, right? If you're looking in the mirror and you see yourself as a lion, but you're a kitty cat, that's a fantastic thing. But perception is reality. I always like this. But what are they seeing? What is their perception? And this is what they're seeing. A lot of it is bad, right? The news sells bad information because that's what people want to see. They're attracted to it like moth to a flame. So what are some of the things they're seeing right now? And these are all, what I'm going to show you right now are all actual articles that are in the news right now. Okay, here we go. So home prices are dropping fast in Phoenix. Here are 6 of the lowest priced real estate listings there right now, including one at $215,000. There's one. Here's another. Huge price reductions hit Arizona real estate market. Then there's another one. Here's how much home prices have dropped in Phoenix. And then there's another one. Phoenix housing market crash could bring prices down 25%. And there's another one. Phoenix sees biggest drop in new housing listings, median price in the nation. Phoenix among 5 markets with biggest home price decrease. In Arizona, one of 3 housing markets set to crash in 2024, question mark. How the Phoenix housing crash will happen. I mean, come on, people. I mean, that's what they're seeing. Every day they're seeing this crazy, like, fear-mongering, what's happening in the markets. But then you're also seeing things like this. Good news. So what do you believe? Do you believe that, or do you believe this? Home prices inch up again in Metro Phoenix. January sales price reaches new high. Now, this is literally the same news channels saying the same things. Are home prices dropping in Phoenix? Contrary to drop in home prices, the data reveals an upward trend. So they're saying it's going higher. And another one, real estate expert, Valley housing prices likely to continue increasing. Continue increasing, that means they've been increasing, into 2024. 10 Arizona cities where home prices are skyrocketing. Arizona ranks number 2 among states where home prices are rising faster than wages. I mean, these are like happening right now. This is 5 days ago. Case-Shiller report, Valley real estate agents say home prices going up. So what is the truth? How can we help our buyers really understand what's happening with the markets right now? Because they're seeing stuff from every angle. I mean, it's just unbelievable what they're seeing. And here's the truth. This is a graph, and I think this is a very, very good representation of why there's so much different perception on what's happening in the market. This is appreciation through the Phoenix and Mesa, the median home values in Phoenix Mesa. So we saw the peak right here, and then we saw rates hit 8%, and then we had this drag down. Remember this? And then we hit rates in the low 7s, and then they got in the 6s, and they're coming back up. This is what you're seeing newscasters say. All right. Here's the good news, people. Home prices are going up, right? They're ignoring this part. They're going up. That's one way of looking at it, right? Because in statistics, we can make anything look like anything. And then another one is this. Oh my gosh, home prices are going down. Yeah, they would be if you looked at the peak versus now. And then here's another perception. Home prices are going up. So in reality, what are they doing? It really depends on how you're looking at the overall look at things. And keep in mind, these graphs are based on the median price of home selling. So does that mean the prices are going down? It doesn't. It just means the amount of homes that are selling is at a lower price range. So that may mean that prices are still going up, but more homes are selling in the lower price range than higher. So they average all of that are selling, and it's lower because more homes are being sold in a lower price range. So all of this statistics is just, you can make it look however you want it to look. So you can make your own perception, you can make your own reality just by making little graphs like this. And it's really, really hard for the consumer. So we need to look at the facts, look at what's really happening, and look at the forecasts. So every one of these people that's collecting data, and mind you, Fannie Mae right here, they are probably the most realistic collector of data because they see every appraisal. They see all of the values coming in. They see all of the purchase prices for all of the neighborhoods, and they've been tracking this for years. This is how they get the data to do appraisal waivers because they collect everything in real time. So they're predicting 6.7 to 2.8%, 6.7 in 2023 and 2.8% in 2024. So that's still positive. The average is right around 2.8 last year and 1.5. So you're seeing all of these being positive. That's a good thing for real estate. So when people say what's happening with the market, it's kind of flat to normal is what I would say. A 2.8%, I mean, any appreciation around the 3% is about where it should be, 3 to 5%, right? So we're just under normal, but that can be expected with rates being where they're at. So that begs the question, if this is normal, based on where rates are at, what will rates do? Well, I already told you higher for longer. So now look at the new perception of what rates would be. We thought they'd be in the 5s, by late or like middle 2024. Here's the new predictions. Quarter one, 7, quarter two. So this goes through what, April, May, June. We're going to hit 6.9. That's not much different. That's a little flat. Remember, kind of flat like we talked about. And then towards the end of the year, that's where we're going to start to see cracks. And then the election is coming upon us. So maybe it's going to be a little bit better at that time. But rates still in the 6s through the end of this year. So most likely won't hit the 5s until about 2 years out, a year and a half out, depending on the overall economy. It's going to be really interesting to watch the inflation with wage inflation. That's what I really want to really focus on. But as long as we have supply and demand, we're going to have stable real estate. And this is an interesting graph. This is the permits for single family detached housing over the last couple of years. There was a spike in permits in 2022. And then look at the drop off last year of the amount of permits being requested. That's not a good sign for having more inventory to the market. That's not a good sign. When you have a drop this quick, this huge in the amount of permits for single family homes, that means that the amount of homes coming to the market is going to drastically drop. The forecast was up here and we went way below that. So what does that mean? That means supply and demand. Supply and demand. If there's less supply and high demand, prices will go up. And that's kind of what we're seeing right now. That's why we're staying so stable. So in this market, how do we educate our buyers that are priced out of the price range? So we all have those buyers that wanted to buy a $500,000 home when rates were great, but they just didn't buy it for one reason or the other. Now, how do we help them? Well, I have a really nice presentation that I'm doing for buyers right now that wanted a house that was higher priced, but now they're saying, well, I could, excuse me, I guess I have to settle into the lower price range, or do they? So let's look at some examples, and this is what we're helping buyers really understand. So this is a report that I've created that the budget for this person was right at $4,500. They wanted their payments to stay right around $4,500. And in today's world, you know what? I'm going to go live on this. Hold on one second. I'm going to move this and I'm going to show you the actual presentation as if a consumer would see it. And this is what it looks like. So when I'm controlling it from their computer, they're going to watch me highlight things like this, and it's going to be highlighted on their computer. So this is their scenario right now. They're at $650,000 purchase. They're putting 10% down. They want their payment to be at $4,500. This is where they would land. Rate right around 7.125 would give them that payment. So we look at the breakdown. We see the payment breakdown, $3,900 here, taxes, insurance, mortgage insurance, their total payment here. Okay. Now, what if we asked the seller for 3%, but we went up in price range? So what if we went to a 725 price range and then we asked the seller to give us 3%? We're going $75,000 higher in price range, which is a big jump. And you know the type of home you can get for an extra 75 grand. It looks a lot different. And now we buy the rate down to 5.99 with that seller credit. We're at the same payment and they're happy at 5. This is a permanent rate buy down. Okay, we're at the same amount, 5.99, and we're 75,000 higher in purchase price. So now they're able to get that home that has the pool that they don't need to rehab, right? So that's one scenario. Or let's say, you know what? I really wanted higher than that. I wanted closer to 750, 775. Okay, let's have a look at that. What do we need to do? This is a 2-1 buy down. Okay, 2-1 buy down will temporarily lower their rate from 7.125 to 2% below the first year. So their payment, the first year will be 4401. Okay, the second year, it will be 4984. The third year be 5460. But if we did this one and then refinanced, so they're at 775, right? But if we did this one, their payment right now would be 4401. But once rates did hit in the 5s 2 years from now, which is where they're predicted, we can refinance them permanently into that same rate, and they'll be up to 775. So these are the types of strategies that we're looking at for buyers to show them what their power is, the purchase power using rate buy downs to get them to that price range that they really wanted to be in. So I thought I'd share that. Yeah.
You have a question in the chat about how much one of those buy downs were.
Got it. So in this case, let me just should stop sharing real fast. Hold on if I can do that. So in this case, it was 3% of the purchase price. So if you did 3%, that would be 725, like 21 grand, something right around there. So you would ask for that as closing cost credit, and then we would apply that towards buying the rate down to push them into that higher price range. So good question. Now they can always pay for it themselves on a permanent rate buy down, but I do not recommend that because they're going to be refinancing in the future. It's just to get to their price range now, because we all know what's going to happen when next year, when rates get into the fives, it's going to be kind of chaotic. So a great way to show, and I'll show that again, share screen. I'm going to pull this in real fast. A great way to show your customers if they're stuck in this $4,500 payment at a $650 price range, because that's all they can qualify for, pushing them higher with the same payment using seller credit to buy the rate down. Same payment across the board. And then here's their future refinance plan once rates drop. But hey, if you did it right here, you're almost on a permanent rate buy down, you're almost where they're going to be in the future, but you're at a higher price range now and you don't have to mess with the high multiple offer situations, which is a perfect segue into my next screen. Multiple offer solutions. So here's your solution for the day on multiple offers, because they are happening. I had 2 customers this weekend with multiple offer scenarios, and cash was part of that equation, and they were going against cash. So let's look to see what are some solutions that we can put together so that our buyers who have financing can compete with cash offers in a multiple offer scenario. So we're going back to 2020 and 2021 again, guys, with these multiple offer scenarios. They are happening because inventory is low and it's going to continue to be there. Here's the first one. Fully approved mortgage. What does that mean? It's not a pre-qualification. It's not a pre-approval where the loan officer has everything and the loan officer has reviewed it. Because we all know loan officers are not underwriters. Now, on my team, we pre-underwrite it because we do have that up front. We have a fully approved loan through underwriting, conditional approval with conditions, and we can even clear all those conditions except for appraisal and prelim before you make an offer. That's a fully approved mortgage. So that is the best way to compete against this. Now, no bank will do that. Rocket Mortgage won't do that. Nobody will do that because it takes a lot of manpower up front. But I've got the team that can do that. What does that do? That removes the financing contingency, right? They're not contingent on financing anymore. It's done. And we have a guarantee that if we do that, and for some reason something happens where the buyer can't qualify, we will give the seller we'll write a check to the seller. So it's a pretty good guarantee. Also, we can waive the appraisal. Now, how do you do this, John? I did this weekend, actually. We had an offer go in, and we were up against a cash buyer. And I went in, and we said, okay, well, what are you going to make? What is the offer you're going to make? And in this case, it was $401,000. So asking price was, I think it was $394 or something like that. They're going over ask, but now they're wondering, well, do I need to bridge that gap? Now, this particular buyer was putting 20% down. I went into our system, was able to run the loan, see if we get an approval, see what Fannie Mae thought of the property, see if Fannie Mae would give us an appraisal waiver, and lo and behold, they did. So we were able to make an offer, waiving the appraisal contingency, like waiving everything having to do with the appraisal, because we don't need one at all. And then the next one, 2-week close. So if you can waive the appraisal, have a 2-week close, fully approved loan ready to go, what do you think your sellers are going to do? If you're the highest, there's no risk. Like, where's the risk? They're going to get paid if it doesn't work. Great. This is the solution that we're going to have with multiple offers as we move into this buying season. So if you have a customer that is in a price range where there's going to be multiple offers, or there's going to be a lot of activity, a lot of competition for homes, please, let's set them up for success by doing this. There's no cost. There's no commitment. There's no upfront fees. We do a soft credit pull, so it doesn't even hurt their credit. Everything is done to protect the buyer up front, including money out of pocket. So that's our solution for the day. I know there's my stupid humor, but hey, somebody's got to have humor, right? So also, large earnest money. If there's no risk, you can put a larger earnest money and make it look even better. So if you have any questions on what's happening in this market and you want to get some strategies on how to make your buyers look the best as far as the competing offers, that's what we're here for. But guys, it really takes the buyer to be on board, and a lot of them just aren't. They're still shopping lenders. They think that they're going to see, they're going to get a rate at 5% from some lender when somebody else is saying 6 and somebody else is saying 7. Most rates are the same because Fannie and Freddie set the rates for everyone every day. So they're very similar. There are some options to get a little bit better rate. That's why we're a mortgage banker, mortgage broker, and a bank. We have a lot of options. But they're hesitant because they don't trust the lender. They don't trust that it's the best deal. But we can do this, and they can still shop if they want. We just need them to do this upfront to set them up for success. So a really good conversation with the buyers when they're in the initial stages, setting expectations, is going to be important as we move into this market. Hopefully rates will come down, but it's going to be an interesting summer, interesting spring to see what happens with inflation and wage inflation. So any questions on that as we move forward? All right, that means I must be a phenomenal teacher. I'm just kidding. If you do have questions, I'm going to look at the chat. Let's see here. If the supply will remain low as predicted, what will motivate the sellers? What will motivate the sellers? Guys, let's just face it. Sellers aren't motivated. They aren't. That's why we don't have inventory. The sellers we're going to see now are those that are forced to sell, those that are being relocated, and really those that are downsizing and paying cash. Like, we're seeing a lot of that. They have a home that has a 2 or 3% rate. Like, who's going to get rid of that rate? Like, they're not motivated. That's why we have this problem with inventory. That's why we need a really good offer, because we need, if they are selling, we need it to be the strongest because the sellers can choose. We do have a seller's market. And now there are some properties out there that are sitting around. And this is where Tina Tambor is going to give some great information. Angie is going to be hosting that at the end of the month. But we are teetering towards a seller's market in most areas. There are some buyer opportunities, and that's where we ask the sellers, if you see homes that are on the market for longer, we have more negotiating room. So there's a hodgepodge, guys, out there right now. There's some areas that prices are going down. There's some areas where prices are screaming up. It's just a hodgepodge. So if your customer is wondering what's going on in the markets, go in there, use the comfort report, show the data, create a strategy, figure out what we can do upfront with the mortgage options. That way you'll be able to empower your buyers to get what they want and hopefully close in a really smooth, easy fashion. So good question. But there is no motivation for sellers right now, unless they're forced out. And that's the reality.
Sean, this is probably a very dumb question, but for assumable mortgages, is that something that was there different seasons of the real estate market, let's say over the last 20, 30 years, that they were higher, buyers were doing assumable rates or assumable mortgages?
Yes, so the assumable mortgages didn't become a thing until rates on the loans of the past became better than rates of the current situation, right? So if rates were in 2s and 3s and 4s, there's no reason to assume a rate in the 6s.
Mm-hmm.
It doesn't make any sense, right? So once the rates started going up and we had all those mortgages in the 2 and 3%, now it becomes really attractive to a buyer to go after that. Now, assumable mortgages can only be done on government insured loans. So what are those loans? Insurance, government insured. We're talking government insurance, mortgage insurance, right? VA is government insured. Mm-hmm. FHA, government insured. USDA, government insured. Conventional loans are privately insured through PMI, private mortgage insurance. So none of the conventional loans, for the most part, are available to assume. Only VA and FHA. So if
Okay.
you have a listing that is a VA or FHA listing, you need to make sure you know what the loan amount is on that, what the rate is, so that if you can advertise this is an assumable mortgage, because anyone can assume anyone. They don't have to be a first-time home buyer. They don't have to be a single or a primary home buyer. They can be an investor and assume an FHA and VA and USDA loan. So if rates are in the 7s and you can get a 2.5, you can try to assume that, but it can only be VA and FHA or USDA.
Sean,
Yes.
on that note, I have one of those situations at 3.6, and I had a buyer contact them, and it's going to be his winter home. So because it wasn't his primary home, they said, no, you can't assume it. Cross Country Mortgage. They're the ones that did the loan and hold the loan.
What kind of a mortgage was that? Was it
FHA.
a FHA? Okay, so FHA is a little different.
Okay.
But every lender has their own rules for that.
Oh, okay.
And I would argue that. I would go back to them
Oh, okay.
and talk to Cross Country, because to be honest, and this is a little bit of and I have a really good company that processes these assumable mortgages if you really want an expert that just does them all day long. Loan officers like me cannot work on these. Only the lender that holds the mortgage can do that. So now they can create their own rules they want, if they want, their overlays. But for the most part, I would call that VA is one of the easiest ones for anyone to assume because of their assumable rules. But I would talk to them more about that. But second homes, when you're trying to assume a second home, it's a little different. And again, I can get you some people to talk to on the ins and outs on maybe how to get after them to try to get that and win that.
Is that the Buy My Rate people?
Yeah.
And
Take
so basically,
mylowrate.com.
Buy My Low Rate.
I think it's take my low rate.
Okay. So basically they negotiate on your behalf because they know the rules.
Yes, exactly.
Where
And
these
they'll
mortgage
take it off your
companies,
plate so
This is
that you don't have to mess with it.
got you.
Yeah. Now they're great and they're really good people too. But I would absolutely reach out to them for advice on that. It's a great way. A lot of lenders won't, it's a pain in the rear end, to be honest, but it's a long process, but it's something that would really help you get a really, really low rate moving forward. Good questions. Any other questions on what's happening in this market? Here's my year of positive thinking behind me. We're going to stay positive, and I hope you guys do too. And let's educate our buyers so that they know how to set themselves up for success. And if you guys need anything, I'll be here all week. And you enjoy your Monday, enjoy the rest of the week, and we'll talk to you guys soon.
Thank you, Sean. Thank
You're
you,
very welcome.
Christy.
Bye, everyone.
And Angie.